Okay, ladies and gentlemen, we are back, and specifically on this video, I would say by popular demand. As you can see, linked in the description below are recent videos that we posted at the beginning of January 2019, which talked about how easy and simply anyone can figure out what the 1 year expected move in the S&P 500 is. And not only that, people were very, very impressed, and people were very, very happy to see just how deadly accurate that prediction is. So again, if you haven't seen those videos, it's totally fine. I have gone ahead and linked to the description below with that information. Go ahead and check it out. But because we got such pretty much overwhelming positive feedback on those, we went ahead and figured and wanted to create a video for you to figure out how to do that in another market, and in this case, the crude oil market. So what you're going to learn on this 6 or 7 minute video here is how to figure out the market's crude oil expectations. And just as easy as it was to figure out the market's prediction using the S&P 500 price and the VIX, we'll be able to do the exact same thing using the current crude oil price and something else which I'm going to show you in about a minute's time. But first, what is the VIX? Right, according to most, the VIX is the fear index, which is a numerical representation of the amount of fear or risk at any given time, which is shown by the buying and selling of options in the S&P 500. Now, that is the super advanced form of that, and it's not really even that accurate, because the reality is, as you all probably know by now, at least if you've seen the videos that I've linked in the description below, the VIX is a 1 year expected move in the S&P 500. And you have all seen this before. This is what the VIX looks like. Right now, the VIX, and today is I think January 31st, 2019, the VIX is about 1657, which means the market is predicting in the next 365 days, it will close within 16.57% higher from what it is right now and 16.57% lower from what it is right now. Now, we can do the exact same thing as we just did in crude oil by using OVX, which is the VIX for crude oil. Don't believe me? Type it into your platform, OVX, and you can see the CBOE crude oil ETF volatility index. So in the exact same way that what the VIX is to the S&P 500, OVX is to crude oil. Very, very cool. And we can see how it looks when the numbers are in there. If you kind of look at the first row right here, if we have a $60 theoretical crude oil price and a $10 OVX, what that means is over the next 365 days from that point, the crude oil market, and by the way, there are literally hundreds of billions of dollars betting on this, so this isn't some flash in the pan estimation. This is pretty accurate, and you're going to see in about 2 minutes time how accurate this actually is. So what's going to happen is when we have a $60 crude oil price and a $10 OVX, that means the expected move over the next 365 days from that point is up or down $6. Makes sense. If we go look at the bottom row down here, on January 1st, 2019, and again, I'm shooting this video towards the end of that month, but on January 1st, 2019, we had a $45.79 crude oil price. We had an OVX, which is the quote-unquote VIX of crude oil, at $51.73, meaning for 2019, the crude oil market was predicting that it would close within 51.37% higher or 51.37% lower, giving the high end of the range $69.47 and the low end of the range $22.11. Now, one of the things that I like to do once I actually see that information is I like to go ahead and draw it on my chart just so I can have some reasonable expectations of what it might look like. So we're actually going to have to shrink this size over here. So the high end of that range, $69.47. So I'm going to go back to the beginning of the year, $69.47, and I'm going to go ahead and draw a price level. And then we're going to go all the way down, and we're going to have to shrink this even more to $22.11. because that was the low end of the range. So what the market is predicting, and what you can see right here in front of you, is when December 31st, 2019 comes around, that the market is predicting that it will close within these two red lines. But you might be saying, well, Stephen, how accurate is that really? Because that sounds great, but how accurate is that really? So we did a study over the last 38 years. So pretty big sample size, not the last 3 years, not the last 3 months. We're talking 38 years. And what we did, we looked back at the price of crude oil on January 1st and the price of OVX on January 1st. And we calculated the 1 year expected move, just like you're seeing right here, very, very straightforward, of crude oil based on the OVX price. So first what we did So at the end of that year, we checked to see if crude oil did in fact close within its 1-year expected move. And the second thing we did was we noted if the price of crude oil at any point in time of that year went outside of the expected move, either to the upside or downside, and we plotted it. Now the results are probably even more impressive than the test we did in the S&P 500, because over the last 38 years, okay, crude oil closed within its 1-year expected move 89.47% of the time. Now, on top of that, it only went higher at any point in time during the year than its high end of the range for its 1-year expected move, right? So, for example, above this red line, only 28.95% of the time. And it only went lower than its low end of the range for the expected move 5 times, being 24.32% of the time. So below this level, for example. Now, here's where the money is made. It went higher than its expected move, but then came back to close the year within its expected move 9 out of 11 times, so 81.81%. That's pretty telling there. And on top of that, it went lower than its expected move, but then closed within, right, came back higher 3 out of those 5 times, so 60% of the time. Very, very, very telling. So how can we make money from this? The first thing we could do is every January 1st, beginning of every single year, we'll calculate the 1-year expected move in crude oil using OVX. Again, exactly how we did it in this slide right here. Very, very straightforward, very, very easy. So that's kind of the first thing we could do. And the second thing we can do is we can plot it on our chart just like I did, or we can go ahead and put sticky notes to our computer or whatever it is for the high end of the range and the low end of the range. Well, why is that? Well, the reason is because over the last 38 years, when crude oil has broken above its 1-year expected move, 81.81% or 9 out of 11 times, it's still finished within its range. So if you're already long crude oil and it hits that high end of the range, well, maybe that's a good time to go ahead and take some profits, because more times than not, in fact, 81.81% of the time over the last 4 decades, it has come back lower from that point to close the year within its expected move. And the same thing for the other side. If crude oil breaks below its 1-year expectation, 60% of the time, so more times than not, it will come back higher to close the year within its 1-year range. So if you don't have any crude oil positions, for example, well, maybe that is a nice buying opportunity. So that's it, guys. Very, very straightforward here. Again, how the VIX is to the S&P 500, OVX is to crude oil. And using that, you can figure out, not only within reason, what the market believes it will close, the crude oil market believes it will close the year, but also how you could take advantage of it, because there are clear indicators of when price of crude oil goes outside of that 1-year expected move, it is way more likely to close a year and come back within that expected move than it is to stay without. Happy trading. I will see you all on the next video.